morning, everybody. Again, this is Adam Goldstein with the Federal Home Loan Bank, and we thank you for joining today's webinar presented by our friend Ben Plotkin, Executive Vice President, Stifel Nicholas, and KBW. We will continue to bring you these sessions every other Thursday, hosting a range of speakers from the Federal Home Loan Bank of New York team and outside experts to cover the topics that are most important in the day. Our next session will be presented by Sandler O'Neill, Scott Hildenbrand, who will cover what you can't predict, but you can prepare for, getting ready for the second half of 2021. Invitations for that will go out on Monday. Before we get started, just a couple of announcements from your Federal Home Loan Bank. I want to remind everybody that are using the letters of credit to collateralize your state municipal deposits that we now have allowed our members a pathway to dividend income with a capital stock purchase requirement on those letters of credit. So if you haven't come in yet, just be prepared when you call the desk that they'll ask you for that. Also, tomorrow is the last day for funding of an MPF loan, end of an era, over 20 years in the MPF program. We've converted over to our MAP program. Please contact your relationship manager to schedule a one-on-one session to get set up on MAP if you'd like to sell loans into the Federal Home Loan Bank. For those of you who are members of the IBANYs group, their conference on April 19th and April 20th, our very own Brian Jones, Tom Citino, Muriel Brunken will be presenting a session on the state of the housing market and our new MAP program. So if you haven't heard about it and you're an IBANYs member, you can listen in there, or we could do a one-on-one with you. For those members that are dialing in from the Caribbean region, I want to remind you that there's still availability in the Small Business Recovery Grant Program for this most recent round of funding. For those of you on the mainland that did get into that funding, we encourage you to submit your forms as soon as you can for funding for the loans that you got reservations for. And for those of you on the waiting list, just bear with us as we kind of get through this final round to see what we can do for you, if anything. Also, important reminder that earlier this month, we sent out a notice on replacing your RSA devices. This is very important. It gives you access to the bank to do transactions, wires on our OneLink system. Those RSA devices will be expiring at the end of the month. It's very important. We're working on replacing your tokens. And if you have the option, you will have the option for either a hard token or a soft token. So someone from our security team will be reaching out to you if they haven't done so already. As always, you can contact your relationship manager if you have any questions. Also, I guess finally, you probably know that April is Financial Literacy Month, and we will be on the virtual road supporting our members for the cause, doing anything that we can to help our members in their financial literacy efforts in their local communities. So if there's anything that you think that the home loan banks can do to help you, give us a call. We're happy to do so. We have presentations set up, ready to go to help in financial literacy. And during the month, we'll also be engaged with every member regulator. We have calls set up throughout the month of April with all of your regulators. So if there's any hot topics or anything that you'd like for us to cover in our meetings with them, let us know. This is very common. We meet at least once, sometimes twice and three times, like last year, a year, with your regulators, just to have dialogue with them about what we're seeing, and they do the same. So if there's anything you'd like us to cover or ask of them, we'd be happy to do so without obviously mentioning your name if that's important to you. Okay, with those announcements out of the way, before I hand it over, just a quick comment on today's webinar. If you have questions, please submit them at any time through the question box, and they will be answered at the end of the session. We're always looking to enhance the programming for our members, so we ask you to complete the short survey that will come out following today's webinar. The topics and speakers we select for these sessions come directly from feedback from you, so very important that we hear from you. With that out of the way, I'd like to introduce my friend Tom Citino, Vice President, Director of Member Relations, who will introduce Ben. Tom?
Thanks, Adam. Good morning, everybody. It's really a pleasure to be introducing Ben. He's going to be speaking about the next wave of M&A, and it's really interesting to us to see how this is all going to unfold here at the Home Loan Bank. M&A is very important to us because it impacts our membership. It impacts the composition of our membership and also the size of our membership, and it could also have a positive or negative impact on our overall outstanding advanced levels. So we always strive to have strong advanced levels, and when one of our members gets acquired, that could be impacted. So we're going to be listening closely to what Ben has to say. But like Adam had mentioned, Ben is a vice chairman at Stifel Financial Corp and is also an executive vice president at KBW. In his role there, he does provide strategic advice to financial institutions when they're evaluating a potential M&A. So he's well positioned to have this discussion with us and our membership. So just a little background on Ben. Ben joined KBW in 2013 upon its acquisition by Stifel. And like I mentioned, he's a EVP of KBW and vice chairman of Stifel. Previously, he was chairman and CEO of Ryan Beck and Company, which merged with Stifel. He was an investment banker there. Ben's also an attorney, was an attorney at the Washington, D.C. law firm. He also has industry experience, which includes serving as a senior executive and board member of a thrift holding company. So Ben received an undergraduate degree from the University of Florida in economics and a law degree from Georgetown University Law Center. So with that, Ben, it's a pleasure to turn this over to you, and we're going to be anxiously listening to what you have to say today. So I'll turn it over to you.
Well, great. Thank you for that warm introduction. Good morning, everyone. I want to spend, I don't know, the next 45 or 50 minutes to talk about kind of what we're thinking about as a new M&A wave is, we think, here, and from our vantage point, we think is going to only grow in size. Let me, if you have questions, just put in the chat, and we'll try to get to those as those come across. We have some materials we'll page through, but we won't get too bogged down in numbers. I think FHLB will send this presentation to you afterwards. So first, let's paint the backdrop here. A year ago, almost about right now, right? The global pandemic was declared. We were all scrambling in our businesses. At your bank or credit union, at Stifel, at KBW. I mean, we've got 8,000 employees. I mean, it was crazy the way we felt a year ago. The bank index basically had fallen steeply. And by the way, it's since doubled. We've returned to that level. Everybody was, including the regulators, were concerned about credit implications. Provisions were going to be hiked in the second and third quarter of last year. Deferrals soared, especially in the New York City market. And M&A basically came to a complete standstill, in March and April of last year, and kind of was that way, for much of 2020. But then I'm a capitalist at heart, and I would say that the banking industry proved how resilient the industry is, and how capitalism prevailed. I think the good underwriting the industry had done the decade before, and I've been around New York banks since the late 80s, so I've seen good underwriting and bad underwriting, but I think this time around, good underwriting paid off. Knowing your borrowers worked well as you designed a complex deferral program for many borrowers, rolling out PPP programs, notwithstanding dysfunctional government involvement, I believe was a success, both for the banking industry and small business. Managing, digital adoption acceleration, which went through the roof as people stayed home and did their banking in the home, for the most part, were successful for most banks, especially banks, with some scale. The outgrowth of all of that recovery effort has been a recovery in capital levels and bank valuations. So when that happens, whenever you see bank valuations come back, you see consolidation start to pick up, because the macro forces encouraging consolidation in our fragmented banking business. And when I say our banking business, I mean both the non-banks, the neobanks, and our community banks. Those macro forces never disappeared. It was just the pandemic interrupted the flow of those forces as everybody focused on survival. This week, we saw deals in California and Florida. Earlier this month, we saw big deals, M&T in Peoples and WSFS in Delaware and Bryn Mawr in Pennsylvania. And, as I indicated, I think over the next 60 days, you'll probably see a lot more. And from our vantage point at KBW, we're just fortunate we get to see what's coming down the pike. So my purpose today is to provide some context for this next M&A wave. So let's just turn a few pages here. Hopefully everyone's got my screen up. So as I mentioned, the forces, the structural forces never went away. There's been margin pressure, continues to be margin pressure. The digital revolution is going full speed ahead. The need for branch consolidation, the need for scale, getting acceptable returns for shareholders, and in many cases, succession planning issues are the forces that drive consolidation. But as you can see from the chart on the right, the pandemic interfered with that. And now, my thesis is that is starting to turn around. You haven't seen it yet in the numbers. We're early in 2021, but it certainly is. Deal activity over the last 10 years, if you look at the bottom here, this is just in the Northeast and Mid-Atlantic. You can see already, just because of the a few larger deals that have been announced, volumes of almost $10 billion, as of early March. So something is happening, something is picking up. And again, to give you a 10-year perspective, you look at the price to tangible book value, you can see we're back. And again, the sample size is small thus far in 2021, but kind of back in that 140, 130 range, which is obviously down from the peaks in 2018 of 174 to 160% of book, but it's certainly recovering. The PE numbers on the bottom are kind of screwy right now, frankly, because provisions were high last year. We're starting to see negative provisions, so it's hard to judge too much by those reported price to last 12 months earnings. So pre-COVID, everything was fine. COVID, things were awful. And post-COVID, frankly, to me, this is my face laying like, we're not really sure yet. I mean, what happens after stimulus disappears? But, kind of everyone's going forward and the structural forces are back in play. Scale as a principal thesis for M&A was certainly working before the pandemic. You can see the differences in pre-tax, pre-provision income before the pandemic, especially between billion-dollar companies and companies up to 10 billion, 154 basis points to 233 as you got bigger. And that relationship is continuing to evolve. I mean, we all know that the bigger banks have more levers, to push or pull as it relates to driving, their expense base down relative to their revenues. Pre-COVID, the large banks were saying kind of no acquisitions. Obviously, since then, PNC has done a large acquisition in Texas. M&T just did a large acquisition after people wondering for a number of years when they would do that. COVID hit, and kind of the world before and after. I mean, if you look at the bottom of the page, the KRX metrics, and these are the regional bank index. Before COVID, we were looking at a 6% pre-tax, pre-provision growth rate. Now it's probably negative especially when you back out the impact of PPP process. And we've got to a situation where the 10-year is lower, even though we've had a run up in the last couple of weeks. But return on that bottom left there, that return on average tangible common equity. I know we put a lot of acronyms in our decks. It's running at about 12%, which is 100 basis points lower than what it was pre-COVID. So banks, I think have managed the credit costs of the impacted industries, at least to this point, and they're learning to manage, and they've learned to manage in a remote world. I mean, I think banks have done spectacular in learning how to do business through Zoom. Um, we're seeing the decrease in deferral rates. Look where it was um, in first and second quarter of 2020. We're down to 1.3%, which is a sign of healing in the credit markets. Asset quality continues to stabilize, although reserve levels, you see in the post-COVID world there on the right, reserves to loans are up at a 1.25. They were at 99 basis points. I'm sorry, they're much lower than in 2020. We thought they were going to be at 99 basis points in 2021. And so people, the provisions are still there. There's been some reversal of provision. I think we'll probably see more. Bank stocks have come back. As I said, they doubled from their lows early last year. It's really this rotation that you hear about and read about away from growth stocks back to value, which has helped the bank stock certainly over the last month or two. Although banks continue to trade, at a relative discount to the S&P 500, you can see this table on the top here. The KRX is trading at 15.8 times earnings. A 15-year median is 14.8. The S&P 500 is at 21.5. Obviously there is a fair amount of liquidity and speculation in the broader equity markets, but that really hasn't influenced where banks are trading. Banks are really trading very close to their 15-year PE multiple. Price on the right-hand side, price to tangible book value. You can see it's almost back to its long-term average. It's up to 150. The 15-year median is 185% tangible book, and we're pretty close to that. So now, we've got some other headwinds that's going on. We've got the net interest margin pressure from a fairly narrow 10 to 2 spread, slowing loan growth, especially when you back out PPP loans. The investors remain intensely focused on banks, earning their cost of capital. Net interest margin has come down. Loan growth, the bottom here, when you exclude PPP, it was expected to be 3.9%. There are some banks, I think, in the New York market that will struggle to get to that level. Again, taking out the noise of the PPP loans. And over half of the banks in the KRX, that's the regional bank index, will have negative pre-tax growth from 2019 to 2021. That reflects that macro pressure on banks to consolidate. Earning the cost of capital, when you go through a bunch of arithmetic and figure out the cost of capital, what does a bank have to earn to justify remaining independent if you're a public company? And I know we have many mutuals and credit unions in the photo as well. You don't need to worry about this, but it's about 11% today. And frankly, that's almost exactly where the core return on average tangible common equity is. In past years, you can see, banks were earning substantially higher than their cost of capital. And finally, I think the hurdles that I think many banks, especially some of the larger bankers, focused on is digitalization, especially from the competition from non-bank competitors. And the costs of accomplishing that are very significant. One proxy for that is, I love to show this chart. PayPal's market cap today of $294 billion is higher than the entire market cap of all the banks in the KRX, the regional bank index, which is just astounding. Chime, obviously another fintech, market cap, is greater than Signature, all the kind of regional banks got a $15 billion market cap. So you can't. The same thing is true. PayPal has got a market cap, almost as big, as Bank of America. So whenever we talk about forces affecting banks and affecting consolidation, we want to focus on the non-banks as well. The digital adoption, the bottom of this chart, this is information just from some of the regional banks, is off the charts. And I think everyone on this call, I'm not telling you anything you don't know, you're well aware, that your customers very quickly have gotten comfortable to engaging digitally. So what happens now? I think it's going to be the same three building blocks, of growing banks. M&A for those that want to be buyers, for those looking to exit, for those that want to remain independent. It's your return on capital and optimizing your capital structure, and then finally, the never-ending battle, to get operating leverage, to get expenses under control relative to revenue growth. I think when it comes to the consolidators, you continue to execute on value accretive acquisitions, but respecting the M&A guardrails. As many of you have heard us use that term before, but it really means the financial constraints of what's an acceptable deal to the market and what's not. And there's been, I think, tremendous acceptance of this. So we're just seeing fewer unquote undisciplined transactions. It's part of what investment bankers do, is try to counsel their clients as to what, if you're taking someone's stock, you'd like that stock to trade well, and what are the elements that need to go into a deal to make that happen. But premiums are down. Tangible book value earned back period. There have been no transactions greater than $100 million, with more than a 4-year earn back in 2020. That was not the case in prior years. And so it's all about, coming up with transformative deals. For independent-minded banks, M&A, every time you see it, represents an opportunity to acquire disaffected customers and employees from merged entities. And I know many of the smaller companies on this call realize that and jump at that opportunity. Capital, the debt markets have been very important for banks that want to stay independent, because whether it's through preferreds, which are tier 1 capital, or subordinated debt, which are tier 2 capital, it's enabled companies to have the capital and preserve their opportunity to stay independent. So today, if you ask banks between 20 billion, 600 billion, the vast majority are saying they have interest in M&A, and we're seeing that play out in discussions. I'm not going to go through all the statistics. You're welcome to look at that at your leisure. But we're seeing bigger deals when you see PNC and BBVA get done for 11 billion. Huntington and TCF a few months ago, which we did, was $6 billion transaction. You just saw, M&T and People's, also a very significant transaction. So it's happening, and the reason it's starting to work is, most M&A is just about the relative value of the currencies between the buyer and the seller. And so as price to tangible book values go up for potential acquirers, they're able to pay prices that interest sellers. It's pretty simple when you think about it. We use this pay to trade ratio on the bottom here as a proxy for it, and that is, what is the price to tangible book of the buyer's stock relative to the price to tangible book paid in the transaction, and you want that to be less than 1. And also when you see a dispersion between price to tangible book of, for smaller banks versus bigger banks, so you see here banks less than $1 billion are trading 105% of tangible book, while the banks above 10 billion are trading at 197%. That's what creates fuel for M&A activity, which is why I can say with some confidence you will see this M&A wave grow in size. And at the same time, for the mutuals and the credit unions on the phone, this fact that the micro companies are only trading at 105 a book does create the ability to get cash transactions done as well, because there are fewer buyers for the micro companies. So that's an opportunity we can talk about at the end here. So we expect to see consolidation to reach pre-COVID levels here pretty quickly. The large part of the industry is much more active than it was pre-COVID in looking at deals. The tech industry is a significant competitor. When we put out deposit market share numbers, we're always just looking at banks because, frankly, we don't have good data at how much the neobanks or the Goldman Sachs banks and all these pure tech-oriented institutions are getting in market share. We expect more non-banks to buy banks and buy banks. You just saw that with Lending Club and Radius. And ultimately, the efficiency ratio will be a key success variable. So I think I talked about this. Number of deals and deal volume is starting to come back. And it's really because the valuations of acquirer stocks, have gotten stronger. Most buyers today that we talk to are looking to do more meaningful transactions. Part of that is, the regulatory process is a burden, whether you're a small company, a large company, in doing multiple transactions is difficult. So if you're going to go through the process with the regulators and with the market, it makes sense to do transactions that are meaningful. You can see that on this right-hand slide here, that, back 2016, 2019, the median seller to buyer assets was something like 14, somewhere 17 to 14%. And that jumped up, to 27%, 24% in 2020. I think you'll see that number continue to rise in 2021, more meaningful deals. Just because if you ask most acquirers that are $10 billion, they really don't want to buy a company that's, $300 million. They want to do something that moves the needle at their company. These are the trading valuations today in terms of recent transactions. And you can see, again, 2021 year to date, 154% price to tangible book value. The pay to trade ratio I mentioned earlier is at 0.85 this year. And that kind of means that will tell you that deals in the aftermarket will perform well. You can see on the bottom of the page, the one-day market premium. There haven't been huge premiums to market paid in post-COVID in 2020. We've seen a couple exceptions in 2021. Part of the reasons for that is we're doing fixed exchange ratio deals, and the stocks run, frankly, after the deals have been negotiated. So we see more premium. And the multiples, when you factor in potential cost saves, really buyers are paying about 10.1 times forward earnings with cost saves. That's going to mean the deals are accretive to earnings. The top left, without boring you with too much data here, for those that have been involved in the M&A process, you've heard investment bankers throw around this term earn back, which simply means if there's tangible book value in a transaction, how many years does it take to earn that back from the incremental earnings of the transaction? And so we've been hanging right around 3 years. In 2020 post-COVID, it went down to 2.3. There's only been 7 deals in this table, for 2.5 years in 2021. That's a very healthy number. That means buyers are being disciplined, and more importantly, sellers understand the importance of having an earn back that's acceptable to the market, because they know there's a much higher probability that the pro forma company's stock price will appreciate if the earn back, is 3 years or less. And so that's the best way to think about the relationship between the EPS accretion, which you see here on the lower left, and the tangible book value dilution. The cost savings assumptions have been pretty consistent. In the deals announced, around 33% of the target companies' cost base. Credit marks, those of you who've gone through M&A, a lot of time is spent on what has become a pretty subjective process. That is, to book credit marks, in connection with the transaction. You can see they've gone up post-COVID, in part because companies would like to create that cushion, and the bifurcation between the PCD and the non-PCD. PCD, if you recall, the purchase credit deteriorated loans. More is going in the PCD bucket. Again, you would expect that post-crisis, which is the more conservative way to approach transactions. So all this tells you, if I'm trying to describe, what looks different in this M&A wave, I think acquirers and sellers are being disciplined in a way that should permit this wave to have some sustainability. Generally, in past cycles, looking back over the past few decades of my career in M&A, it's when somebody does a dumb deal that kind of means the M&A wave suddenly breaks down. One-time cost, one-time deal costs obviously remain consistent as well. Many of these represent branch consolidations, branch closings. So banks are using M&A as a way to rationalize their branch system. And you can see in some of the bigger deals, the 6.3%, pre-tax one-time cost, what we've seen lately. So I think these are kind of the benchmarks. Kind of 3-year earn back is what I said, but we've seen EPS accretion. We'd want to see for transformational deals in the 5 to 10% range, and we want tangible book value dilution to be minimal. So just skip forward here. One of the drivers I think of M&A will be the fact that buybacks worked incredibly well for public companies in 2020 because valuations were down. I mean, they were buying their stocks back at 105% of tangible book value and 9.6 times forward earnings. That's a pretty good deal to buy your own stock back, and you would get a 0.5-year earn back. Now, using excess capital for buybacks is a little bit less effective because stock prices are higher. In this theoretical case, which is kind of a composite of the industry, today there's a 6.5-year earn back. Because often when you go in a boardroom and you say, here's an idea on an acquisition, the board will say, why don't we just buy our own stock back? In October 2020, pretty compelling to buy your stock back. Less so today. So I want to just finish up with just talking about the implications, and then hopefully Tom or Adam will have time for a few questions. I know you got a couple of emails before, but let's just talk about it. So for potential buyers, they're looking to get operating leverage, that is, reducing their expense base, relative to their revenue growth base, with smaller acquisitions, while keeping control of their company without too many social concessions. They're trying to offset the margin compression, that they're looking to deploy excess capital in a merger. Now, they can also look at transformative mergers to expedite growth, really get to scale. And a principal driver of this scale argument, certainly on some of these larger deals I mentioned that we've worked on recently, is to build the budget capability in technology. I mean, let's just face it, the spend that's necessary to remain competitive with JP Morgan or with the fintech, if it was 7% of your expense base for true, research and development of new APIs and new functions. For a $5 billion company, you're doubling that budget at a $10 billion company. And that's the one part that's been surprising to me, just how what a strong driver that's been as banks are thinking about how they stay relevant for the next 5 years. And transformative transactions have seen strong initial reactions in the market. Respecting the M&A guardrails is more important than ever. I went through what they are. And I certainly, right now, I'm pretty optimistic that the participants in the M&A process, certainly in the Northeast, get this, get the guardrails, what they have to do. Now, for sellers, for potential sellers, you continue to evaluate your strategic alternatives. What your standalone value is. How much can you accelerate your EPS by doing a transaction? Is there a transaction that's still fair, not only for your shareholders, but also for your employees and community? And I would say one big difference, one implication to sellers that I would point out is the number of actual, quote, auctions like you used to see very commonly from investment bankers like KBW or unnamed competitors. That's really down. I mean, the transactions that are happening among people that have spent time together at an FHLB outing or a trade association gathering or a golf function. And so they know each other and they've kind of had that conversation where company X has said to company Y, hey, if you ever think about selling, give me a call. And so I think for sellers, we encourage you to have those long range conversations, even if you don't think you are a seller, next year, the year after, or the year after that, building that framework, that foundation for conversations is important because in a post-COVID world, I think there's going to be fewer auctions where companies just go out and buy another company they don't really know. And then finally, before opening it for questions, I think I'm on schedule here, is for the independently focused companies, in particular the mutuals and credit unions and the line, or small public companies, I've said this for a long time. You can manage for independence. It's a matter of resetting your stakeholder expectations. That there's nothing wrong with being a low premium to book company if you're trading a low risk franchise with a dividend payout. I mean, there's lots of industries where there's a bifurcation between those, really kind of taking more risk, managing for a higher multiple with a view that they want to be acquisitive. But I would say that the likelihood of a company that wants to stay independent, especially small companies, less than $500 million companies that want to stay independent, if they set their expectations right with their stakeholders and show them they can provide, pick a number, 10% of total return a year because of between your dividend and growth in tangible book value, you can get there. I think that's clearly an alternative. And so also for institutions like that, I think you are going to see lots of opportunities to capitalize on disruption in the market due to M&A. You guys know how to do that. You hire the lenders. I think the biggest challenge is to make sure you've got the technology to be attractive to the next generation, of bank customers, and that we don't cede those to the fintech world. And I'd say the final thing for the independent-minded, institutions is, stay focused on what's happening tier 2 capital, in preferreds because they've become available to much smaller institutions, to private institutions, and they can provide a capital solution that we didn't have in past cycles. So with that, Tom, Adam, I think I'm right on schedule. I left.
Yes, you are, Ben. No, I
Okay.
appreciate you. Right on schedule. So we have some, yeah, we have some time for some questions. But yeah, like you had mentioned, we had received some preliminary questions prior to the session regarding M&A activity and credit unions. So I'll combine both questions into one. So one of our credit unions wanted you to address the dynamics of credit union mergers in this environment versus the dynamics of community banks. And then also, if you could speak a little bit to credit unions acquiring community banks, because that's happened a little bit more regularity over the past couple of years.
Sure. I'm going to focus on the financial side because I think everyone here knows what happens at the credit union regulatory side. With the change in supervision, I don't think we know exactly yet, but clearly there's precedent for credit unions, being involved, as acquirers of banks. It's happened in Florida quite a bit. You can also combine credit unions. I think one of the optimistic takeaways from this conversation for credit unions on the call is when I showed you that for banks, micro banks, banks less than $1 billion, that those that are public are trading at 105% of tangible book value, even with the rally. I think there are going to be a fair number of quote orphaned smaller banks who always thought they had an upstream traditional community bank buyer. That may not be the case. As I said, acquirers want to do more significant transactions if they're going to do those. And so in credit unions or mutuals the same, are cash buyers. And so they tend to want to do low price to tangible book transactions. I think, you want to look where others are not looking, and that's on the small side. So it may not be transformative if you're a larger credit union, but I think those are deals that can be done and should be done. It's funny. Some of those banks are being looked at now by fintechs, which do have a lot more regulatory hurdles than credit unions because they've got to go through bank holding company. The latest example we just saw, Lending Club by Radius, up in Boston. I can't tell you how long that took. It just took a long time. So credit unions have an advantage versus the non-bank buyers. So hopefully that answers the question.
It does. Thank you, Ben. We did receive a couple of questions. One is discussing cultural fit, which is obviously a big factor when entities think about M&A. So how does the assessment of culture change under COVID, and will uncertainties surrounding culture assessment in this COVID environment, would that potentially slow down the pace of M&A? And then is this a potential danger zone for missteps to occur?
Yeah, I think it's a great question because, mergers, especially mergers of equals or transformer mergers, are so much more than, the arithmetic of a transaction. It's about, the fit. You heard me a few minutes ago talk about how most of the regional deals are happening between companies that have some familiarity with each other. And so they kind of know the CEOs. They've been on a roundtable with them. I mean, certainly that's the case. I don't want to get into specifics, but the recent larger transactions, in New York and Connecticut, and, Pennsylvania and in terms of the ones that are public, if you read the background of a Huntington TCF transaction, you can see that the CEOs knew each other for a long time. They knew the cultures of each other's companies. So I would say absolutely, CEOs of acquirers are not going to pull the trigger and do an acquisition without understanding the culture as it reflects the character of the CEO. But in many cases, because of years of industry gatherings, they know the other CEOs, and they've just been waiting for a time when, first of all, the stocks align, the arithmetic works, the macro environment is going. So culture is important. I mean, that's why I say that there's fewer auctions because it's very difficult if you don't know, the target company's CEO, and at the same time, all you're doing is reading a book that an investment banker has put together with some budget. I'd say those deals are more difficult to do today, and that part will be slower. But the other part, where companies do know each other, I mean, there isn't a significant size bank in this country that doesn't have a tier one, tier two list internally, on the CEO's desk that he or she can look at and say, those are the companies I track. I track their stock price. I get together with their CEOs once or twice a year, and that's what will drive M&A.
Okay, thanks, Ben. One question that I had as a follow-up to that, what about getting deals done now in the remote environment? I mean, are deals getting done with less face-to-face interaction, or are folks still getting on planes and need to have that face-to-face discussion, or has things changed where these are getting done over the phone and on Zoom?
Yeah, I am shocked how streamlined deal making has become in the video conferencing world. I mean, if anything, I was just, as you know, we're very active, and other than the CEOs getting together and doing that kind of one-on-one discussion, maybe among the top two or three members of a management team, almost all the recent transactions, almost all the diligence, has been by Zoom/video conference. Data rooms, obviously loan files digital. It has made it better. I'm just telling you, it's made it better. It's made it more efficient. You set up different subgroups. Each of those subgroups are meeting by Zoom. So if you would have told me that 2 years ago, never would have believed it. But some of the recent transactions, the diligence has been 100% virtual.
Okay. Yeah, so there's been good adaptation to this current environment.
Yeah, that's why I say the resiliency of the banking industry and financial services. I mean, we should all thank our lucky stars. We're not in the travel business, the hospitality business, so many other industries that have been decimated. Financial services, whether it be broker dealers, investment banks, we've been able to adapt and be resilient because of the use of technology. And the same thing is true for deal making.
Right. Okay. And last question, Ben. A couple of years ago, this question pertains to a couple of years ago. Some deals were getting done for liquidity reasons. Retail deposit gathering had become very difficult and very challenging. So deals were getting done for liquidity capabilities of the new combined entity. So how does that play into the new M&A landscape? Is that going to impact or delay some M&A in the coming years, considering the massive amounts of stimulus money that reside in depository institutions today?
Well, it is funny how all we talked about 2 or 3 years ago was loan to deposit ratios and how high the loan deposit ratios were in the New York market and how that was going to inhibit M&A, and now everyone's awash in liquidity. I think the general view is this is an aberration. The liquidity that's come in from the stimulus, and because of people haven't been spending, they've been saving, is going to revert to the norm. And if anything, the competition for deposits, especially from non-banks, from fintechs, is going to become more heated, because remember, there's a lot of fintechs who are raising deposits, neobanks, and they're not showing a profit. They don't need to show a profit. All they need to show is that they've got new customers and they've grown their revenues. It's kind of, it's not a playing field that's exactly fair when you think about community banking competing in that situation. So I think acquirers are kind of not looking at the loan to deposit ratios right now, but kind of long-term averages. and the quality of the deposit base, how sticky those deposits are in the face of digital competition. And so there's a little bit more subjectivity, but I would certainly, it might not be the predicate for looking for an M&A deal, but it's certainly something that folks are focused on. Who's going to have a strong client base post this aberration in terms of liquidity, and who can compete well in a digital world? I mean, I tell you, the big difference is those banks that are branch heavy, that haven't done the pruning of their branch system, will become less attractive, as acquisition candidates.
Okay. Well, thanks, Ben. That concludes the questions. We really appreciate all your insights. It was a great session. So thanks for joining us. Really appreciate it very much.
Great. Well, thanks for having me. I hope everyone on the call stays healthy. And take a look at the deck, and you're welcome to reach out if you have questions.
Yeah, you could either reach out to Ben, or you can come through one of your relationship managers, and we could funnel Ben any questions that you may have. But feel free. Keep the dialogue open between all of us. So thanks for everyone for attending. Just as a reminder, April 8th, Adam had mentioned earlier, Scott Hildebrand of Piper Sandler will be conducting a session called You Can't Predict, But You Can Prepare, getting ready for the second half of 2021. And he's going to be discussing ALM strategies and tactics to best position your institution for this new point in the interest rate cycle. So that should be a good one. I hope to see you then. That invite will be going out next week, early next week on Monday, I believe. So have a great day again. Ben, thanks for joining us, and we'll see you all again soon.